The breakdown in yields raising new concerns in the credit market, as if we didn't have enough to worry about. Let's bring in Steve Liesman to talk more about this, where health crisis, sort of market semi-crisis, now bleeding into credit problems.
Yeah, I mean, it's just a natural extension of what's going on, if you think about it, Brian. Fears of recession, fears of a decline in revenue, fears of decline in sales and profits raises questions in this world of highly leveraged companies with a lot of debt out there. Now, look, going into this, every appearance is that they were in pretty good shape. There was a lot of debt out there, but the economy was doing pretty well. Coverage ratios were pretty good. Some of the debts or covenants that were written were kind of on the iffier light side. But we talked to all three major credit rating agencies, and they all, for lack of a better term, have the hair standing up on the back of their neck. There will be more. S&P told me that the pace of downgrades will quicken. Fitch has yet to downgrade anyone because of the coronavirus. Only 27 companies at S&P, say of a universe of 4,000 corporates, have been downgraded because of corona. Who is it? Well, it's Samsonite and Sabre, travel and tourism related companies, some of the weaker airlines. When you get into the sovereign space, you want to look at countries, for example, that get the predominant of their revenue to service their debt from tourism. You want to look at commodity companies and commodity countries. Those are the ones, what's going on in the debt of the oil patch better than most.
And there was some action today. By the way, there was some midstreamers that were able to sell some debt or at least raise some debt today. But I want to bring up one instrument, too, because you're always trying to look for like a litmus test on certain things. The BKLN looks like Brooklyn, but it stands for bank loan. This is a bank loan, Invesco Senior Bank Loan ETF. Stephen, I think if our audience wants to look at one thing going forward for some sort of a litmus test, look at that BKLN. Right. It's just my opinion only, but I think that's the one you want to look at because it's full of, investment grade and mid-speculative grade. We haven't seen it trickle through yet. You're saying we may be at the beginning where
everybody's on watch right now. Look, this is not the financial crisis at this point, and there's not an expectation it becomes that. But the idea that there will be downgrades and investors need to just sort of be careful. If a yield on a corporate bond looks too good to be true, it probably is. If a dividend yield on a stock looks too good to be true, there's a reason for that, which can probably be found in the balance sheet of the corporation.
Steve, you're talking to both central bankers, rating agencies. Prior to this, we had weakness in Europe. When I look at the European banks, the charts of the European banks, they look awful. They're on the cliff of death. Is anybody concerned that perhaps this tips Europe into a deeper recession and the European banks have an issue?
Most certainly. And I will tell you also going into this, Fed officials were already, before this, complaining about the high levels of corporate debt in the U.S. Let me give the other side of this, which makes the short in this market a bit of a wild card, which is yields, spreads have risen for some of the high-grade yields of the speculative credit, but interest rates are also down. So that helps with the cash flow. The other thing is there could be bailouts. The IMF and the World Bank came forward and said, we put out the welcome mat for countries that are having trouble. So that's an important issue that something looks like it may go down. It's possible it could be helped by a bailout. Europe is another issue all unto itself.
So the high yield market here, are there any big deals that are pending or? I mean, I haven't really seen that much activity in the last few days.
I think you haven't seen anything because there's nothing to see. I have read an enormous number of debt research reports recently. I think I saw something that said there have been either no deals or one deal in the last several weeks. I have to go back and check. I will let you know. But there aren't deals out there, which raises another question, which is the question of liquidity. There will be some companies that have to roll over their debt, and they were structured in a way that, hey, the credit markets are open, no problem rolling. That could be a problem if they come to roll and they can't roll because liquidity is dried up. This is a problem, a potential problem in the speculative grade credits, not in the investment grade. When I look at the walls, which are what comes due when, investment grade is a couple years down the road. They have been smart mostly over this period of time of low rates. They've done what we call termed out, which is they've extended the debt and refinanced it lower on the investment grade.
Steve, it's easy to take pot shots at the Fed. I'm not here to do that, but I want to ask a question. Hopefully it's not too convoluted. Steve mentioned something, hasn't seen this in his career, where you have 1,000 points to the upside, 1,000 points to the downside over a matter of days. I would suggest it's a function of complacency built up over the last 10 years as manifested in the volatility index, because in my opinion, the Federal Reserve has been the backstop and people have gotten lazy in terms of the risk, thinking the Fed has our back. Now you have a VIX that went from 14 to 40 and people are paying the price. Does the Fed, do you think they acknowledge that maybe they've added to the complacency of what's been an extraordinarily complacent market?
I think there's concern about that. Eric Rosengren, the Boston Fed president, has spoken about this. He was opposed to some of the rate cuts we recently went through because of that reason. He was one of the guys, by the way, before the market got spooked, who flagged WeWork as a problem, as an issue out there. He was concerned about that. There are those who are concerned. I will tell you their operational standpoint in the face of this is what's called, can I get a little music? Macro-prudential, just to make it more palatable. The idea of doing it from a supervisory standpoint, get on the banks for holding too much speculative stuff on their books so that you don't have to adjust monetary policy to keep the economy from going into a bubble that could burst. That's been their idea since the financial crisis. Will it work? Well, we haven't been through this yet. We perhaps, and unfortunately, might find out on the backside.
Steve, second time at the NASDAQ today. I believe you were on this morning with
so much fun here. And going over the George Washington Bridge is maybe one of my favorite things to do.
A couple times a day. That's not deflation.
Does sarcasm translate?
$15, coming in or whatever.
Does sarcasm work on TV? I don't know.
Steve, thank you very much. Good stuff. Appreciate that. Look at the HYG high yield ETF BK, the BKLN, what we just talked about, the JNK. Anything else you're watching?
So the BKLN is really an interesting one here because Steve just talked about the fact that the Fed is concerned about the banks. My view is I don't think we're going to have a problem with U.S. banks. All the fire trucks are right outside the banks with their hoses ready to go in case there's a fire. That's not where the risk is. The risk is in these leveraged loans. The risk is on investment managers' balance sheets. The risk are in foreign investors that have invested in these things searching for yield. So I wouldn't worry about U.S. banks whatsoever. I would be worried about all the other stuff, these leverage loans and those type of things, and even in the oil patch, those type of things. That's where you're going to see if this health crisis turns into and morphs into something else. Again, I don't know if it's happening. I'm not saying it is, but that's what investors have to watch to see if it starts to morph.
This is going to sound grotesque, but there are some financial predators out there that have outcomes that they would like to see occur.
Sure, there are.
You know what I mean? And if you're looking to
Black Swan, yes.
Yeah.
This is not to say people are out there saying, but think about it nowadays, all the instruments, right? It used to be if you want to short a stock, you shorted the stock. Now, you don't like a stock, Adami Corp, you short it, you short the ETFs that you're in, and then you buy the triple short Adami. There's all these instruments you can use to just
Right. And
Mike Tyson's punch out. Remember that body blow, knock him out.
The problem is what Steve just said, where he left off saying they're thinking about there could be a bailout, which turns that whole scenario on its head.
Yes, and then we go boom.
Exactly. Keeps people a little held at bay when you start to see these are transitory, hopefully transitory issues that you might see a bogey taken on a lot of these.
Hold on. We got to go. I'm getting yelled. Could we have a 2,000 point up day on the Dow?
Absolutely.
Markets in turmoil.